right. How about that? Yeah, now we got a microphone. Testing. 1, 2, 3. Testing, 1, 2, 3. The Wayne in Spain falls mainly on the plains. The ants in France stay mainly in your pants. Who's alive? You got me? We have sound, we have video? Yeah? No? Hello? Oh, good. Well, I never know. All right. Welcome to Trade Non-Farm Payrolls live at FXStreet's YouTube channel. This is the 190th month in a row that I've done this webinar with FXStreet. 190. Holy smokes. That's longer than that other YouTube guru that you watch every day. That's longer than they've been alive. So anyways, welcome. My name is Wayne McDonell. I am the Chief FX Market Strategist for TradersWay.com, a boutique foreign exchange trading firm that would like an opportunity to earn your loyalty and respect. I'm also the Chief Currency Coach at FXBootcamp.com. Yeah, an educational site. Yeah, yet another educational site. But I've been around longer, and it's actually better. It's actually better. Check it out. You want to learn technical analysis? Check it out. Fundamental analysis? Check it out. FXBootcamp.com. You want to learn about central banking policy, monetary policy? Check it out. Day trading, swing trading, scalping, position trading. It's all there, man. Price action. Cool. So anyways, nice to meet you. Hey, Arthur's checking in from Ghana. What's up, Jimmy? Welcome. So James wants to know, hey, how do I get going with my trading career? Subscribe to FX Street's YouTube channel. Also visit FX Street's website. Go through the data, go through their live webinars, go through their recordings, and come to live streams like this. If you happen to like my style, you can further that if you have money. Because it's $88 a year to join FXBootcamp.com. $88 a year. You're like, no, that can't be right. No, I know. Yeah. So anyways, cool. So who is me? If you're going to listen to me, let me introduce myself. My formal background, I started with a paper route, and then I got 2 paper routes because I like money and I like working hard. That's cool. Then I worked for a nonprofit organization and learned how to run an organization of 3,000 people, sat on a board of directors with George Soros. Not bad for someone 21 years old. Yeah, that George Soros. Yeah, seriously. Cool. Then I became a high-tech entrepreneur in the Silicon Valley. Almost became a billionaire. Like billions of other people, almost. That's cool. I did create some successful businesses. Now, the interesting thing is that's almost 30 years ago, whatever the number is. I can't remember. Maybe it's 30, maybe it's 25. I don't actually know, but it's a long time ago. And the business I grew from 4 people sitting in an apartment in the Russian district of San Francisco, dead broke. I joined the company, made it a success. I talked to a client that just signed up last year for that business, and he loves it. Now think of it. I built a company 25 to 30 years ago that was funded on somebody's credit card who was actually now then broke. I joined the company. 30 years later, they have a customer who couldn't stop talking about how awesome it is. Isn't that great? Cool. So after that home run, I became a venture capitalist, which is pretty cool. I loved that job, and I thought I'd be doing that for the rest of my life. I was doing really well. We just, I joined that company when it was fairly small. We grew it to about 300 people when I was there. We took over 2 entire floors of a skyscraper right next to the San Francisco Fed. There I am, 30-something, and I got a beautiful office with 3 windows. And when you look out the windows, you see the San Francisco Bay Bridge and Treasure Island and all of San Francisco Bay. Oh, man, was it awesome. And what was I doing all day? Listening to entrepreneurs pitch me. And I would decide whether I would invest or not. Sometimes I would fly them out so I could see their prototype. Sometimes I'd hire industry experts to get their feedback. Oh, man, was it awesome. And then I read an article about Forex. And when I verified it is actually $2 trillion a day. You got to remember, back then it was $2 trillion a day. And I thought that was stupid. I thought, what a dumb article. What a dumb article. $2 trillion a day? I'm looking for $100 million a year market. $2 trillion a day? I'd never heard of anything so ridiculous in my life. So I looked it up. I found out that Forex was legit, and I started to teach myself. A couple of years later, I quit my job. That was that. And I became a full-time Forex trader. So why do I bring you on this journey with me? Well, now you know my point of view. I'm a businessman. So I like planning. I like preparation. I think of Forex as a business. Okay? How different is the world now? Well, more liquidity, less volatility. So it's much, it's not crazy anymore. But you also have to understand, when I first started, there was no education. There are almost no retail Forex traders. It's pretty interesting. When you opened an account, you couldn't use a credit card. The minimum to open an account, I think, was $5,000. And you had to wire it, which was a problem for a lot of people. Like, it just wasn't easy. Then once you got your account opened, it was just, let me do this. You got something that looked like this. Oops, come on, let me grab this. Okay, that's what it looked like. Okay, blip, 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 and you're like, what do I do now? Well, now you got to pay $150 to $250 a month to have charts. Okay, and then so I paid the $200 a month to get charts, but then I'm like, I don't know what to do. Okay, so you would get something like this. Okay, well, imagine you're opening a chart for the first time and you get something like this. I'm like, I don't know what that is. Or I don't know if I have any of the old templates anymore. You remember like the standard templates you get with MT4? I don't get them. They're dumb, right? So anyway, so I'd look and I'd like, okay, what is this stuff? I can add an indicator. I'll add accumulation, distribution. I'm like, okay, I don't know what that is. It just kind of looks like this thing. So then I would add this and I'm like, what's an alligator? What are these? I'll add that. And then I'm like, okay, I don't really know what this is doing. So what is this thing, right? And all of a sudden, it was weird. So what if I use the gator? What's a fractal? Let's add some fractals. And I'm like, is it doing anything? There's these little arrows. And it says up at the top and down at the bottom. Like, what does that mean? That looks like the wrong thing. So anyways, you're playing around with the charts. And like, I don't understand any of this. And there were no books on Forex. And there was no books really on technical analysis. Like, when you get this MT4, it doesn't tell you what this AD is and what this alligator is and what this other thing is. It just doesn't tell you. And I'm like, I don't know what this is. So anyway, so then you come along to the world and you click buy and it puts you in, right? No, it wouldn't do that. Because you couldn't trade on your charts. So you would say, I don't know what this is, but maybe I buy that. Then you'd go back over to this thing, which was a different application. Okay. And then you'd go click. But then you're like, where do I put my stop? So then you go back to your charts. You're like, well, I would put my stop. I'd put my stop here. What is that? 135.22. So then you go back to your trade, and then you modify your trade, and you're like, I put the stop at, what was it again? 1.3522. But then you couldn't see it on your chart. You see what I mean? And all of a sudden, it was really slow, and you could really make mistakes. You could leave limit orders in the market, all this kind of stuff. Okay? Boy, it was difficult. And then later on, once I became, once I started working with FXStreet, let's say, I worked with FXStreet, and I said, hey, let's do something really amazing. Let's take the most volatile moment in Forex, which is non-farm payrolls, and wrap education around it so I can teach things like patience and discipline. And I share everything I learned, good, bad, and ugly, about trading Forex. We'll make it 3 hours long because no one ever does that and all this kind of stuff. But also, here's the thing. Non-farm payrolls would come out, and in 1 or 2 minutes, the market would jump 300 pips in a minute. Maybe 2, maybe 3. 300 pips. 100 pips a minute. And then what? It would come all the way back down. Maybe drop 300, 400, 500 pips down. So imagine that's because there were less participants. You see? There was less liquidity. There was more volatility. So you might say that was good, but it may not have been. And in fact, your spread might have been 50 pips. The slippage would have been crazy because of that volatility. And you could lose a lot of money really quick. Now, the sales pitch you heard from scumbags and scam artists was how much money you would make in a minute or two. But of course, in reality, that wasn't the case. Okay? So here I am. I teach patience and discipline. And and trade planning based on fundamental and technical analysis. Okay, I've passed the Series 3 in the United States. I have a macroeconomics degree from Harvard, and I have a financial management degree from Harvard. So I know a little bit, and of course I have 20 years of experience trading Forex. Cool, right? So feel free to ask me questions, and I will do my best to help and share. I am a servant. Okay? But treat me with respect that I feel that I deserve. So if you're here to heckle, you're going to get crushed because I got an army behind me. How many people are on my team? Who's on my team? Where's my family? I saw it, Johnny. Saw it. Awesome, man. Yeah, who's got my back? Hoorah! That means if you're a heckler, you better watch your back, bro. Because I brought my posse. Yeah, cool. Yeah. Darko's trying to be... Dude, Darko, you're a good friend, man. All right, so technical and fundamental analysis with the overriding goal of putting together trade plans. That reminds me of a disclaimer. Welcome to Trade Non-Farm Payrolls Live 190 at FX Street. Let me remind you that the purpose of this presentation is education. This is not an alert service. I'm not here to make trade recommendations. But I will conduct technical and fundamental analysis, and I'll do so in real time, pip by pip, candle by candle, with the overriding goal of helping you put together trade plans throughout this beautiful, wonderful New York trading session. If you're trading along with me using a demo account, then regardless of whether your plans are successful or not, you will have an opportunity to learn. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Now, if you find the first non-farm payrolls I did 190 months ago, I gave you the exact same disclaimer, and I still today believe that is absolutely true. Okay? Joe Mann, what's up, Bubba? He says, what's going to happen to the U.S. dollar? Well, that's a great question. All right. So I thought December, the U.S. dollar would be weak. Well, it was strong in the first 2 weeks. Well, let's do that. Let's just pick up euro dollar. Let's just do a euro dollar quickly. I guess this is fine. Daily. May. Oh, that's not quite right then. Too far out. October, November, December. Just too far out. All right, so let's go through this. Where's my drawing tool? Pardon me while I get my drawing tool. There it is. All right. So I said December, the US dollar would be weak. This is euro dollar. Okay. And so the first half, it was, where is it? All right. Anyways, the US, so there's December. So it wasn't weak. And then it was weak. Okay. So in December, I said, so let's do this. December, I said euro dollar up. Okay. Then I said in January, okay, euro dollar down. So again, let me label this euro dollar. So you have to do this inverse. I said the dollar would be weak, then the dollar would be strong. And then in February, I said euro dollar up. Okay. And then lastly, March, guess what? I think this has some down in it. Okay. So again, up, down, and now up. Can anybody confirm that that's the truth? Okay. Jim says 100%. Johnny says indeed. Okay. And if you knew this, let's say 100 days in advance, before December. Okay. Type in 100. If you knew my strategy and my plan 100 days before December, type in 100. I want to make it clear that it wasn't hindsight, that we could logically and intelligently discuss it at least 100 days in advance. Because if you don't know, then you're an amateur, right? And you're like, Wayne, that's impossible. Yeah, maybe for you, but it is possible. Okay. All right, let's do one more because I'm trying to wow the new people because so many people come in and they don't know me. So they have an agenda or they have a lot of stuff like blocking the information I'm trying to share. They're blocking it because they've been burned by idiots before and all this kind of stuff. And they're just really searching for help. They don't know. And so they come in and they don't trust. And I get it. I wouldn't trust either. Okay. All right. If I have told you, let's say 100 days ago, okay, 100 days ago, let's start with this. Think about this. Go back 100 days. If you knew that I thought the stock market was going to come down 10 to 20% in January, type in 20%. Again, 100 days ago, did I tell you over and over and over and over and over and over and over again the stock market was going to come down 10 to 20%? So guys, if you're fairly new and you're right, all I'm trying to say is I'm not a genius. I'm a supermodel, but I'm not a genius. So instead, if we can discuss this 100 days in advance, what the dollar's going to do, what the stock market's going to do, what the bond market's going to do, then there must be a repeatable pattern, or at least an understandable logic. And if it's a logic, then it can be learned. I hope you agree with that. This is all I'm trying to establish, that if it can be done, it must be logical. And if it's logical, it's learnable. Now, maybe I suck as a teacher. What can I do? I'm trying my best. Maybe my best is mediocrity. I don't know. But the thing is, what you should, if you don't know me or you don't know the markets, I want you to hear this message. You can learn it. You can learn how the market works. And by the way, it's not all priced in. I want you to think about this. If you listen to a guru that says everything is in price and you don't need to know fundamentals, what they're telling you is they don't know fundamentals. I'm going to do one more aha. Okay? I want to do one more shock and awe, and then I'll leave it at that. Okay? How many people saw me trade exactly right here? Up. Okay? In fact, I told you I was going to do it at least a week in advance. One more shock and awe. In fact, in that moment, I discussed with people that there's nothing on the chart that says this is going to happen. There's no technical analysis at that point that predicted this. Okay? Nothing. But I'm like, it's going to happen. Here it goes. Okay? So I love technical analysis, and I'm not poo-pooing on technical analysis. I love it. When I see a chart, my heart races. I love technical analysis. I love trading. But all I'm suggesting is, if you can open up your heart and mind, there's more to it than just technical analysis. It's great, and you got to know it, and you got to be good at technical analysis, but there's more nuances than that. If you're going to, trade like this, or if you're going to say, on the third week of March, I'm going to sell dollar and hold it for 90 days. Now, some other traders, they have to wait till the third week of March, and they don't know what they're going to do yet. They're like, so what's up, fellas? What are we doing today? Are we buying or are we selling? What's going on? What does my Arun oscillator say? When does my alligator say, help me, RSI, help me? Well, those things are good, but if you already have a strategic plan, then your tactics using these technical indicators should be so much more improved, because maybe you trade let's say a moving average crossover. When are you going to get out? How long are you going to hold it? And you're like, well, that depends. Well, look, I don't even know what's happening yet, but I'm going to probably do that, and I'm going to probably hold it for 90 days. And then I go in with technical analysis. Now, how did I get here? How did I come up with this type of trading? Go back to what I was explaining. I'm trying to share with you my point of view. How did I teach myself Forex? Well, you got to remember, I didn't open my charts first and look for a trade. So I would do fundamental analysis first, and I would spend about an hour a day. And what I did for myself is I basically created indices like this. Now, I did this manually every single day, and I used rate of change data provided by my broker, because remember, all I had was this. And in one of these columns was rate of change and some other things, right? Open, high, low, close, rate of change, and all that kind of stuff, volatility. Okay, so I would take that data and manually enter every single number into a spreadsheet that I created on Excel, and I'd create these indices. And I would, from analyzing this, I would say the yen is weak and the euro is strong. Maybe I want to look at buying euro dollar. What else is strong? Nothing. So it'd be the only thing going on in my book right now. Everything else is weak. So I could, buy euro against Aussie, buy euro against CAD, buy euro versus yen, buy euro. I could also do that. But long story short, I would spend at least an hour doing this every single day. And eventually it would lead me to log into my trading account now. And I would end up here. Let's say on a 15-minute chart. That was pretty standard. Okay. And then guess what I would do? Now I would do technical analysis. You get that? That's how I taught myself Forex. That was the first step. So if you trade crosses, okay, if you trade crosses, you like this technique. This is called relative strength. Okay, so so these are crosses. Euro versus Kiwi is going up. Of course, we already knew that. Euro Swissy is going up. Of course, we already knew that. Why? I showed you the indices. Okay, these are all crosses. Euro Norway, Euro Aussie, Euro Dollar. There's no Euro Pound, Euro CAD. Oh, well, that must be Euro Pound that's not there. Interesting. But anyways, those are crosses, and that's how you get that, is through relative strength exercises. Then when I got my Series 3 license by the National Futures Association and the Commodity Futures Trading Commission, they talked about things I never quite thought about so much. And that was fundamental analysis. Why is the money moving? Never really thought about that, but of course it's important, because if money does not cross a border, the value will not change. Okay? If money does not cross a border, if money does not flow, if cash stops flowing, the value will stop changing. So if money just circulates in an economy from one citizen to another citizen, okay, we call that velocity. If you want to look up the velocity of money, we call that velocity. How many times does it exchange hands? Let's say it's crazy high because there's a shortage of money or something. So the same dollar gets traded a lot. How much does the value of that currency change? None. Now, go to Machiavelli, right? If you think about Italy in the time of Machiavelli, it's probably not a great example, but whatever. Let's just say there was a situation where there were many little fiefdoms. And let's just say they had modern foreign exchange, right? When money goes this way, okay, what's happening? Country A is buying stuff from country B and C. So what happens? Country A is trading their money for country B's money, and country A is trading their money for country C money. Now, why would they want the other country's money? Because they want to buy stuff from vendors in country B, country C, and then they send the stuff back. But they don't accept your money. Okay? So you would have to go to the Medici. Remember, this is the time of Machiavelli. So country A would go to the bank run by the Medici and say, hey, we got country A currency and we need some country B currency and we also need some country C currency. So they trade with the Medici their A currency and then they get B and C currencies from the bank and then they buy whatever they need and then that gets sent home. So if country A is rich, what's happening is they either don't have their capability of making or growing the stuff they need from B and C, or maybe they're just so rich that their people don't work. And if you got to pay a country A worker, they're like, dude, if I got to get off my butt and do something for you, you're going to have to pay me a lot of money. But country C and country B, they're like, dude, we want the work. We'll do it for you. We'll give you a good deal. So it may be in country A's best interest to work with country B and country C. Because A is so rich, everybody's fat and lazy. They let their money work for them. So they trade. So what happens with the Medici? So let's look at the bank. They have a lot of currency on their balance sheet. Okay, we'll call this assets on right, and liabilities are on the left. They have a lot of currency in country A. And they get more and more and more because country A keeps trading with the Medici. We need more B. We need more B. We need more B. So there's a shortage of B. So what happens to the value of the currency in country B? Because these country A keeps coming along. We need more B. Give us some B. I need B because we want to buy more stuff from country B. We need some B currency. Give us B currency. We want more B currency. Well, demand is high. Demand. A is demanding currency B a lot. So the value of currency B skyrockets. But now the supply of currency A at the Medici's bank is getting bigger and bigger, and they don't like it anymore. They're like, dude, we're holding a lot of this A, and you want to give us more A for B? All right, well, we don't really want it, so we're going to give you a less good, less favorable exchange rate, because we don't really want your A. We have too much A as it is. So the value of A, currency A, is falling. At the same time, currency B is rising. But the funny thing is because A is so rich. Remember, they're the ones that are fat and lazy. They don't even have to work, for crying out loud. They make the B workers work. So what's happening? A's currency is depreciating. B's currency is appreciating. Meanwhile, the same thing is happening in C. D doesn't like A. They used to be in a war. Okay? So they don't work with A anymore. And now these guys do so much business with A, and these guys do so much business with A, that they don't really do much with D. Okay? So D has a closed economy, and they got citizens here, and they do all their business in D. And the money flows from one person. Okay, this one person's spending is this person's income. So then they spend their income, and now their spending is this person's income. And then they take their income and they spend it, so it's this person's income. And it goes around and around and around. Okay? Spending is equal to income. Savings is equal to investment. And money goes round and round and round and around, right? Spending is equal to income, and savings is equal to investment. You're like, Wayne, it's the same thing. Yeah, I know. Think about it. Okay, sorry to drop that bombshell. But what happens to the value of D's currency? Nothing. Okay, these countries have their currencies appreciating. This country has their currency depreciating. And this is not doing a damn thing. You need to have an open economy to attract foreign direct investment and develop business relationships. Meanwhile, think of the standard of living in B and C. It's skyrocketing. What's happening in the standard of living in country D? At best, stable. Depends on what they do with their investment. Okay? Cool. So then I look at that, and that's what I learned. And then I became a macro trader. And a macro trader doesn't say yen euro necessarily because of what's happening in the market now. This is just telling us recently. Currently, the yen has been weak, and currently euro has been strong. So analyzing my own trade history back in the early days, most of the time I did good, but then I would run into a wall, and what was working would stop working, and I never knew when. And it added a level of fear and distrust in my trading because it was working now, but this doesn't tell me it's going to change directions today or tomorrow. It just tells me what happened yesterday and now. So euro yen looks good now, euro dollar looks good now, but what about Monday? I had no idea. So macroeconomics is a little different. And it goes back to studying and deciding you want to sell country A, generally speaking. And you want to buy, so sell. I made a decision fundamentally now because I think these relationships are going to continue, fundamental relationships. And so now I say to myself, I'm a buyer of B, and generally I'm a buyer of C, and generally I'm a seller of A. So I combine this fundamental analysis. I have to learn how to make this decision. But once I've made a decision like this, I can say, in the moments where, let's say, A, B is down, I'm selling. And in moments of A, C is down, I'm selling. And if the market is sideways or up, so let's say sideways or up, okay, no trades. Because the relationship would be weird in that moment, and I don't really understand what's going on. Why is that happening? Why is B buying back A? Because remember, only foreigners can do it. So why is C selling their A? something going on here? Is something going on here? Is something going on here? I don't really understand. So at least at the basics here, if these are falling, generally speaking, that anytime you're in a downtrend, you're selling lower highs. But if it's sideways or up for today, you're like, well, that's just today. There's some sort of thing going on, but I'm going to wait because generally speaking, maybe not today, not tomorrow, but more often than not, these things would be falling. And therefore, that's how you're using your technical analysis. When should the falling resume? Okay. So first you get your fundies, aka bias, and then two, when it's not working anymore, you use, well, I guess always you use technical analysis to confirm or deny. Okay, confirm or deny, spelled wrong. Okay, you see? And there's a new level now. So you're not just like, well, this worked yesterday, so maybe I'll try that again. You can do that. And I did that. That's where I started. And maybe that's what you do when you're fundamental bias type macro trades. We call that macroeconomics. Why is that macro? Why is that macro econ? Because I'm studying multiple economies. And like relative strength, I understand what should be weak usually and what should be strong usually, and I pair them up. Not what was strong and weak last night, but over the next 2, 3 years, 5 years, 8 years. Which one should usually be weak and which one should usually be strong based on how they work with each other globally. It's interesting, right? Will you be able to rewatch this later? Yes, try YouTube. Cool. So, that's where I come from. That's my point of view. And you need to understand that if you're listening to me. Otherwise, you don't know my language. Cool, right? Cool beans. So, this is non-farm payrolls, and we have a data release. Now, I want you to understand something. News is not fundamentals. News is a data set. Thank you, moderator. This is one data point in a set of data points. And your analysis of the data set is fundamental analysis. So let's do a chart here. Okay. And non-farm payrolls looks like this. These are all just points. Okay. And today we think non-farm payrolls has come out. It's going to be a low number. So we're there. Good, bad, whatever. Okay. Well, an analyst would say, okay, the first thing they would do is they'd look at this and say, why, oops, let's do this in black. Y, gee whiz. Okay. Y is equal to, so now, right, you got to do something like this. Y is equal to mx plus b. Okay, so this is the y and x axes. B is where is the intercept. Okay, this is, I don't want to do that because it looks like a formula. Anyways, B is the intercept, M is the slope. So then you tackle this out and you're like, wait, the slope. Okay, M is equal to rise over run. So what does this all mean? A statistician would look at this data set now of all these NFP numbers and say, well, what is the mean? So you go average, 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 average. Okay? This is B, by the way. Cool. All right. Rise over run. Okay, the run is this way. Oops, let's do that in a different color. Let's do that, I don't know, pinkish. No, that's too close to the other one. Greenish. Okay? Okay. Okay. Rise over run. As we get more and more data sets, how steep is the slope of the mean? Okay? And then, of course, you can do some additional analysis. How far does price tend to move from the mean or average before it reverts back to the mean? So you can add that up and say that's a standard deviation below the mean. And then you look at this and you look at this. Okay, it comes up and then it reverts back to the mean. Comes up, reverts back to the mean. Comes up, reverts back to the mean. Comes up, reverts back to the mean. So you'd say that's a standard deviation above the mean. So now you got y equals mx plus b. You're analyzing the data set of non-farm payrolls. You're looking at the average price and the average deviation from the mean. I mean, that's what standard deviation means. Okay, so you look at this and you say, well, generally speaking, over this period of time, non-farm payrolls has been improving. And that there will be drops, that's fine, and there will be rises, that's fine. But generally speaking, you're fairly bullish. Okay? And that's what we call fundamental analysis. What your last guru would say is, NFP is a good number, buy it. You're like, dude. Oh my God. Oh, look at that number. You should do something. You should buy it. You should. Anyways. So, NFP is going to be disappointing. And here's my fear. In the first few minutes, it's released. We find out the number's not very good. So let's say it's 100,000. Well, that's below the mean. Okay? That's below the mean. It's not good. But what does it mean? Different mean. How does this get translated? Well, we're worried about inflation. We're worried about wage growth. And we're worried about how far the Fed's going to raise interest rates. Right? Isn't that what we're actually trading right now? Wage growth, inflation, and interest rates. So if the number is below the mean, okay? Okay, then it's disappointing. Wages should not grow or grow more slowly. With slowing or falling wage growth, inflation should fall. And in that case, if you thought the Fed was going to raise 5 times this year, you will have to adjust this way, and maybe it's only 3 or 4 times in your opinion. And the market, in some people's opinions, has priced in 5, which is the dumbest thing I've ever heard, but that's okay. I'm not here to outsmart the market. But now they might find out, oh my God, not 5 times, 4 times, or 3 times. And the market could move in actually a favorable way. The stock market might rally, because there's less hikes being priced in, which means you change your model, right? As you know, the expected return of a stock is equal to, you remember this? The risk-free rate of return plus the beta of the market, right? The expected return of a stock. The expected return of the the beta, so you got to do the market. The beta of the market, the expected return for the market, right? Minus the risk-free rate of return. Everybody knows this. Common sense, right? You learned this in kindergarten. Cool. So if you're adjusting the level of risk-free rate of return, all of a sudden the stock market was overpriced, and then we changed the risk-free rate of return or inflation level or whatever. It all ends up being related. You can use a different model if you want. But anyway, so the stock market crashed because of this pricing model. And then all of a sudden, if it came down because people were priced in 5 hikes, but now it's only going to be 3 hikes, then all of a sudden stocks are cheap again. Boom, the stock market rallies. Then 90 minutes later, someone else comes along and says, wait, why was non-farm payrolls only 100,000? Is inflation killing the consumer? Is demand falling? Are we going to go into recession? What is this all about, Basil? And then all of a sudden what? Now demand is going to fall, and then the stock market drops again. Because now they're worried about, other people are talking about, this is the sign, we're going to go into recession, it's all over, everybody in the cave, start prepping. Buy your bullets now, buy your gold now, the world is over. And that's my fear, that you're going to get this mixed bag of misunderstanding and volatility. So be careful today. We're prone to having many traders making mistakes because we don't all agree to what is happening, what is going to happen, and how fast these things we don't agree on is going to occur. And from my analysis, I actually listen to central bankers. I actually read the central bank reports. I don't listen to the idiots on CNBC and Bloomberg. I read the reports myself, and then when I listen to the idiots on Bloomberg and CNBC, I don't understand how they get to their conclusion. It's like they have an opinion. It's like they are pretending if they were in charge of the Fed, what would they do? But that's not the question. The question is, what is the Fed going to do? Not what you think they should do. What do you think the Fed would do? What do you think the Fed thinks about what the Fed will do? And how do you get that? You read the same reports that they do. You listen to their speeches. They do tons of speeches. Almost every day there's a Fed speech. And you read the meeting minutes. And you actually listen. And you know what? They tell you exactly what they're thinking and what they want to do. And then you find out, oh my God, many of the experts are guessing. And they're opinionated. I'll tell you right now, I don't have opinions. I have conclusions. I can be wrong, but I can justify why I'm wrong. Cool. So good luck today. It's going to be interesting. You guys excited? Hate says you need to update the video description. It still refers to Trump's presidency. I don't know what you're talking about, bro. Maybe it's an FXStreet thing. Yeah, I guess it'll be the FXStreet thing. Interesting. Okay. Now, Richard says, today it's go big or go home. That's silly. That's ridiculous. Yeah, James says, bring it on. Cool. So let's go to euro dollar. Yeah. You're long gold. All right, good. I have to take that. I think we have time. Yeah, I got 2.5 minutes before NFP comes out. By the way, could you please post the number when it comes out? Let's take a look at gold. Gold is great. Gold is good. Gold works. Let me show you gold. Okay. Statistically speaking, okay, gold has not changed value since the summer of 2020. It's kind of gone up a little bit, down a little bit, up a little bit. In fact, now we got a mean and it's tightening. So going back to the summer of 2021, it's done even less. If you're trading gold, you're trading a market that relative to other currencies and other assets has done jack, has done nothing. Not a very good investment. Meanwhile, Bitcoin went up 100% and then dropped 50%. And gold has done nothing, statistically speaking. Now you're like, well, Wayne, I bought it here and I got it out there. Whatever, bro. Because if you did this and that, you missed 19 different trades that would have produced higher returns for the same amount of risk. So you traded mediocrity. Isn't that interesting? Meanwhile, oil went from 0 to 100. Okay. So let's, which one should we do? Aussie, I guess. Insert indicators, custom. And I'm going to do price action pivots on this. But I guess euros, I mean, this is the only cross rate, right? So, yeah. So anyways, please post the NFP headline number. And then while you do that, I'll actually get the data. Oh, not too bad. Okay, better than expected. So that'll probably tell everyone the Fed is definitely going to raise interest rates. Okay, great. 467, right? Yeah, that's what I got too. This is what I have here. Coolio. So it's good that the economy is healthy, but then it's bad because people expected less, which means the Fed has permission to jack up interest rates. Now people are going to debate, will the Fed raise interest rates by 50 basis points in March? Okay. But we're not just looking for a headline non-farm payrolls. I mean, that's a good number, but we also want to look at wages. %15 of people are telecommuting, which is interesting. 6 million people reported that they had been unable to work because they lost jobs to the pandemic. Interesting. $1.8 million people say they can't even go to a job interview because they might die of COVID. All right. Employment growth continued in leisure and hospitality. By the way, I just bought a couple of plane tickets and I'll probably buy another one today. So I've been busy making Delta Airlines rich. But let me tell you, okay, I bought an airline ticket from Atlanta to New York City direct. $150 round trip. And I looked at the airplane like I picked my seats. Empty. That's pretty amazing. $150. To give you an idea, you could pay as much as $400 on a regular, scenario. $150 round trip, not each way. Round trip. And then of course I get upgraded because I'm platinum, so it's crazy, right? Isn't that amazing? So I wonder about this, but maybe the fact I'm flying to New York will boost leisure and hospitality. Okay. Professional and business services, retail trade, transportation, and warehousing. So that's all good. So everyone's going to work for Amazon.com one day. Employment, in leisure and hospitality increased by 150,000 jobs in January. Gains in food services and drinking places. Great. And hotels. Look at that. So bars and restaurants, big time. And hotels coming back. Cool. Okay. If you have an education, you're getting hired. You probably never lost your job. Retail trade, employment, transportation gained 54,000 jobs. Now that sounds like a lot, except Amazon could probably hire all 54,000 jobs, but also Walmart will probably take all 54,000 jobs to work in their warehouses, not their stores. So not nearly enough. We could do that again and again and again. Okay. Teachers got jobs. Great. Because schools are open again. Healthcare, 18,000, which is great. We got a lot of old people in America. Okay, we need someone to bathe grandpa. So on and so forth. Okay, here we go. In January, average hourly earnings for all employment increased 23 cents. That's huge. $31, bro. They have increased 5.7%. Huge. That's more than probably the wage increase of the last 30 years. So in the last 6 months, wages have gone up more than in the last 30 years. Okay? So next week we get CPI, right? JK Ministry, I went through the pricing model for a stock. So if you look at the better than expected non-farm payrolls, you have to anticipate what? Higher wage growth. Then you look at it and there's 5.7% wage growth. So that tells you inflation. That tells you a higher interest rate, which tells you a higher risk-free rate of return on the 10-year T-note. And that tells you the stock market has to come down. It's just math. But it doesn't mean we're going into recession. It just means when you bought Peloton at $400 a share, you have to understand you're talking about a company that sells you a $3,000 bicycle and you only get one wheel. And you thought that was a good idea to invest into that? Well, it turns out when the government gave money away for free, it was a bad idea. One of the worst mistakes made by a politician since Richard Nixon. Kind of like just leaving Afghanistan was a bad mistake. Now, I sound political, but these things do bug me. That Afghanistan thing was a shit show. Pardon my French. Very disappointing for the people that been there and did the work and then just walk away. Oh my God. Then the second thing was free money and more free money and more free money. And now, in my opinion, all of these problems we're running into, high wage growth, high inflation, okay, this has to do with mismanagement of money, primarily from the misunderstanding of money. And the federal government said, hey, well, the Fed keeps doing quantitative easing and we don't get any inflation. They spent trillions of dollars after the global financial crisis. So then the federal government says, well, why don't we do that? There's no negative consequence. Everybody gets free money and nobody is hurt. Well, that's gross negligence and a complete lack of understanding of how money works. So the consequence, of course, is everybody gets hurt. So you give 10% of America money for free, or in this case, 100% of money for, I got free money from the government. Weird. It's just weird. So everybody gets money for free, but then everybody is hurt. And on the long run, the poorest people are hurt the most because now they got no money, but now when they go to fill up their broken down Hyundai Excel and they go to the gas station, it's $4 a gallon. And they're like, well, I barely got enough money to buy bread, right? So that leads to a much bigger problem. But on the short run, you got money for free. But once you spend the money, now you're broke again. So the consequence is massive inflation because you can't take it back. Okay. So anyways, what I'm trying to get to is high wage growth, higher interest rates. Well, high wage growth, high inflation, higher Fed funds rate, higher 10-year T-note yield, which is a higher risk-free rate of return, which when plugged into financial models, remember, professionals actually use a model based on numbers, real numbers, not guesswork, and they say, what is the value of this stock? What is the value of that stock? They punch in the numbers. Some of the variables you punch in is that new risk-free rate of return. So a year ago, the 10-year T-note was 0.75. Now it's 1.8. And what you might say now, based on this non-farm payrolls, 6 months from now or a year from now, we will be at 2.5. So you must now add that back into your model. The expected return of a stock, okay, this is CAPM as the model, capital asset pricing model. The expected return for a stock is equal to what? The risk-free rate of return plus the beta times the expected return for the market plus the risk-free rate of return. So this number here, the risk-free rate of return, okay, was 0.75. Then it was 1.75. And let's just say in a year, it's 2.75 is your guess. So as you're going through to calculate what is the value of XYZ Corporation, well, you keep changing this number, okay? And when you change it from 1.75 to 2.75, the expected return for a stock is down. It's worth less because this is based on the future value of cash flows. and they're discounted. So the higher this is, the less return. So Facebook was worth $400 when the risk-free rate of return or inflation or a subset of all of this was zero. So they priced out, oh, money's going to be free forever. Why? We haven't had inflation for 40 years. Why would we have inflation now? So, hey, when money is free, Facebook is equal $400 a share. Uh-oh, risk-free rate of returns now not zero, but 2.5. Okay, now Facebook is worth $200. Has anything changed at Facebook? No, you still posted pictures of your cat today. You did it yesterday. So what's happened in 6 months? The only thing that's actually changed is the risk-free rate of return. And therefore, people that know how to buy and sell stocks or know how to buy and sell currencies or people that know how to buy and sell commodities, they saw this coming 6 months ago and they're like, there's no freaking way that this thing's worth $400 anymore because the Fed is clearly going to raise interest rates over the next few years. Risk-free rate of return is going to change. We got to update our discounting models and we got to reprice this sucker. Might as well get it out at 400 because it's probably going to drop very significantly. Meanwhile, your neighbor that used to brag that he bought Facebook at $380 and how smart he is now that it's at $400. Now what's he doing? He doesn't know jack. He's like, well, I got a signal in Robinhood. It told me I should buy it and I'd be rich. Well, he went to school of hard knocks. I went to Harvard. Adam says, why is ADP and NFP so different? Let me tell you something. Oh, I don't know. 15 years ago, I asked Kurt Worley, my quantitative analyst, I said, Kurt, I heard something on TV today. Some guy said ADP predicts NFP. And I'm like, is that true? So he went back through 10, 15 years back before that and found that, okay, there's zero positive correlation, which means if ADP is good, NFP is good. There's zero negative correlation, which means if ADP is good, NFP is bad. Or if ADP is bad, NFP is good. So what we found is there's no correlation whatsoever. Which means ADP measures the payrolls of small and medium-sized businesses. Non-Farm Payrolls is the household survey and the establishment survey. And the government picks up the phone, calls a bunch of people, and like, what's up? They do a little sample, and then they use really fuzzy logic math to say, hey, we talked to 20,000 people. So we'll, from our conversations with 20,000 people, we will tell you about an economy of 350 million people. And by the way, we did it in 3 days. That's why you should probably look at the revisionary numbers, not the headline numbers, because then they have a month in 3 days. So anyways, you're like, what? You talked to 20,000 people and now you're telling me the life of 350 million people? That's a heck of a leap of faith, don't you think? So what we found is these are radically different things going on here. And that you might say, well, Wayne, for the last 10 years, a good ADP meant what? A good NFP. But what I've been telling you is that's because of government intervention or manipulation by pumping money into the economy. It's not a free market. So, yeah, of course they were correlated because they're measuring the same thing but in different methods. The economy is going up because there's free money. The government's pushing everything up. Cool. So it's going up. But once we get to a more normalized market where now it's like, are people and let's say almost everybody that wants a job has a job. Some people are looking for jobs, but most people have jobs. And then there's a lot of people not looking for jobs. So now when you do different math, you're kind of measuring actually different things, not just everything like up until now. So now you get different results. Okay, that's all. Because they're not even similar math. ADP is a payroll processing company, and they count the number of pay stubs that they have. Now, if your company is big, you just do this yourself. You do your own payroll and health benefits and retirement and all that. But if you're a small or medium-sized business, small businesses just don't have the manpower or the money. Medium-sized businesses find ADP more efficient. It's just cheaper to have them do it than if you hired a whole HR department to do it. So you're like, nah, we'll just pay them. So it's small and medium-sized businesses, and they just count the number of stubs. Think of now 2 different surveys by the government. They literally call people on the phone. Hey, what's up? You look for a job? You got a job? What's up? And it's just surveys. And then they're like, hey, cool. So we got this number. So let's do blah, 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 blah. 467. That sounds good, right? And then what? Next month they come back and they're like, yeah, we were wrong. It was 310. Because they surveyed again and got more data. Instead of talking to 20,000, they talked to 200,000. And they find out, no, we were way wrong on this. Sorry. Good enough for government work. We're only 30% wrong. You're like, wait, you were off by 30%? Dude, that's bad. Oh, Machawi says, hey, are you still holding your pound dollar trade? No, I cashed out yesterday. I think it's on this account. But this is just my coaching account, right? No, I'm out on this one too. No. I cashed out of everything last night, in fact. And so I'm going to start rebuilding next week. Oops. Let me click this and click that. Okay. So let me put it this way. I bought it here and I exited here. And of course, if you know how to swing trade, that's just stupid, boring, obvious. Okay. Long story short, the easiest trades so far have just been basic swing trades. And like buying here and exiting here, it's just textbook. There's nothing really interesting about it. Okay? Here, you ready for a sales pitch? If you go to FXBootcamp.com, it's $88 a year. Currently, there's more than 65 hours of training videos. And I teach you very specifically what this means. Okay? Very specific. Macroeconomics, central banking policy, technical analysis, trader psychology, price action, pivot points, scalping, spot trading, swing trading, carry trading. It's all in there. $88. Dude, seriously. So if you don't see these things, you're like, why is this obvious? Well, I don't understand. Why did he put this here? Well, first of all, red means down. And what is this line here? And why did he get out there? And why did he get in here? I don't understand. This was bearish. How come he bought it? Well, just admit you don't understand. Pay the $88. Is that too much to understand? I swear to you, if you pay the $88, you'll be shocked it's not. I'm not charging $1,000. I'm not joking. I honestly believe for $88, you will get $1,000 worth of value. Yeah. FXBootcamp.com. Simple. The same link from 20 years ago. FXBootcamp.com. I have the same phone number from 30 years ago. Okay, I'm very, very, very solid. If you watch the earliest videos of me on FX Street, you will find, my trading has not changed. It hasn't needed to change in 20 years. So if you get an email or a sales pitch from a Forex guru that has an awesome new trading strategy he wants to share with you, pass. Why the hell would you need something new? What, your old stuff doesn't work? Yeah, at Harvard, my classes, sometimes I'd spend $1,000 on the textbooks. If not 1,000, certainly 500 without any troubles. BS says, hey, Wayne, I've been thinking about joining your swing trading group. What happens there? We did it last night. Typically, we get together. I discuss some fundamentals for a while, and I kind of do a wrap-up overview of what's been happening recently in the market to kind of get our heads screwed on straight, because we're trying to predict trades that are 300 pips each. So you kind of have to have a framework of where you are in the world, in the move, in the trend. Then typically I give an assignment and I break people into groups, probably 6 or 7 people. And in the groups, they work together on the task. Sometimes it'll be like, hey, you can only sell the dollar. Go find me something that you want to trade against it. I want 3 reasons why. And then I want you to give the best technical trade plan you can for next week, setting up whatever you want to sell the dollar. So if it's buy pound dollar, I want you to go all the way through the big time frame, all the way down to the little time frame, and tell us how you're going to trade it next week, which is interesting, right? And so then we bring all the groups back together and we have about, let's say, 5 presentations from the 5 groups of the best dollar short trades they can find for next week. And then we talk about it. They present and I interrupt them and I'm like, well, what about this? And what about that? And how did you do this? And where did you do that? And what do you think about this thing? And we talk about it and discuss it openly in front of the group, which really makes you have to think. But the thing is, also, you're learning from others, not just from me. Like, it's fantastic. The swing trading group is fantastic. It's fantastic. I love it. So we did it last night. It was 2 hours. Now, we didn't do group work last night. Oh, is it oversteered? Oh, let me adjust it. It's fantastic. That should be better, right? It's absolutely fantastic. But last night, what I did last night in the swing trading group is I said, look, I feel like you guys get the understanding that you're buying dips like this. And we work on this over and over and over again. So I'm assuming swing traders and day traders, because I have a day trading group, that we do all this kind of stuff. By the way, I got out yesterday and ignored that buying opportunity. Why? Because I'm pretty fly for a white guy. So these were all buys. That was not. But anyways, one of the things, or the thing we talked about last night is, okay, what do you do if you miss these entries? Because I feel like some people still were on this and missed a lot of that, even though it was obvious, even though I showed everyone I did it. People saw it. My orders were right there. It was great. So I said, I feel like you're missing it. So we worked as a swing trading group, even though usually we're planning on the 4-hour. I broke it all the way down to the 30-minute and 15-minute and 5-minute, and I showed people that there's actually 2 trades that every bull should do. The obvious plan A is buy the dip. Buy the dip. buy the dip. So on and so forth. Buy the dip. Okay? But what do you do if you miss that? You miss this, so you don't buy it. And then you don't quite get the pullback, and then you don't buy it. And then you see this, and you talk yourself out of it, and you miss this. And a week goes by, and you're not on your trade. And you're like, well, Wayne, I didn't really get the pullback. Jeez, Murphy, you're kidding me. This went up 350 pips, and you didn't buy it, even though you were a bull? Well, I didn't get the pullback. Oh, gee whiz. That's how I felt anyways. So we spent 2 hours of me teaching you how to buy out a position. How to buy out a position. So on and so forth. So that you should be buying here, but if you miss it, you can buy there. Okay? And if you miss it, right, once again, there's other opportunities. There's other opportunities. So what happens in the swing trading group? That kind of stuff. And then Johnny said he crushed Bitcoin. So using the exact methodology that I taught last night, instant gratification. Thank you, Dwayne. All right, is the microphone better? Lucas? Machawi? Okay. And so right now, dollar is ripper strong, and I couldn't be happier. I couldn't be happier because I dumped my short positions 12 hours ago. Nice. Thank you, Stevie. I'm reading the chat to see, right? Oh, if I'm position trading, would the exits be the same? Let me give you an example, let's say, of a position trade. So let's look at euro dollar daily. And I got to change this now. Okay, template. Okay. Hang on. Okay, position trading bullish bias. Okay. So, currently, the target is 116.40. Okay, the entry was, I think I was in at 111.40, if I remember correct. Okay, so basically 500 pips. Sorry. Okay, that's a position trade. Now, there's one other thing you need to know. Seasonality. Okay. All right. What is seasonality? Let me ask you something. If you lived in Kansas and you were a farmer, what month do you plant your seeds? Please let me know what you think. If you live in Kansas, United States of America, you're a farmer, what month do you plant your seeds? Hello? Yes, I'm being very generic on seeds, but that's fine. Come on, guys. What is there, like 10 people in this live stream? I'm not even watching. Doesn't matter. Seeds. Don't make it complicated. What month do you plant? Dude, it's not difficult. Focus. I'm not a farmer. You have no idea. Seriously. Really, Focus? You can't even make a guess? Okay, well, a lot of people say April, maybe May. Cool, that was the answer I was thinking about. Spring. Cool. How do you know that? Sort of like, why am I going to sell the US dollar in April? Well, why is the farmer going to plant seeds? Now, we have a different season than weather. So farmers go from melt to frost, right? No matter where you are in the world. That's their season. So it's based on weather. Okay, what about traders? It's actually the business cycle. So it's usually, let's say, taxes to taxes. And inside of that, there's humans. Okay, let me ask you something. Give me 2 times in a year you would expect workers to take vacation time. Let me know. There's hundreds of millions of workers in the United States. There are billions and billions and billions of workers around the world. Give me 2 times a year, humans will take time off from work. December and July. Okay, I'm good with that. Do you think that impacts the market? Yes. So, there's a business cycle of taxes to taxes. There's a cycle from December to January to December, to January to December, to January to December. Also in the oil market, there's an increase of supply and an increase in demand. Then an increase of supply and increase of demand. Increase in supply, increase in demand. And we go over and over and over in these cycles. And so I look at all of this and I say, that's interesting. I'm going to sell the US dollar in April. Wouldn't it be nice to know that? Okay. Half the people in this chat right now knew I was going to sell the US dollar in February. And they knew months and months and months in advance. You're welcome. It's just how it works. Why does it work? 'Cause okay, this is not a devastating decline, but we're definitely at a challenge zone. Well, it's similar. It's not, we don't know, like, I don't exactly know because we're talking about an aggregate of millions of people, right, James? If not billions. So it's complicated. There's going to be a lot of variables. But put it this way. If I think the dollar is going to weaken in April and I see euro dollar has been strong but is now reversing, okay, that means the dollar is now weakening at the exact price and time I expected the dollar to weaken anyways, so I take the shot. If the dollar is strong at that moment and it's April 1st and the euro dollar is falling, I don't buy it. But boy, oh boy, when they line up, okay, then I take a shot. And in my book, I call that you see it first with your mind's eye, and then you recognize what's happening if that happens. And now you have confidence to take the shot. But you're lining up technicals with fundamentals with seasonality. And maybe it's good, whatever. Hey, moderator, can you help me with something, moderator? I need to find the 10-year T-note yield on FXStreet. Maybe I'll just do a search. Huh? Captain Obvious. Let me do that. 10-year Treasury. But they're insights. I just want the number. I don't want people's opinions. I just want the page that shows the yield on the 10-year. I think you guys would have that in real time. Rates table, technical level, forecast poll, live chart. Asher, I turned it down. Is it still too much? I'll turn it down more. Okay. But you should also be more polite, Asher. Say it in a nicer way. All right, so I'm on live charts, but I don't think it's going to give me 10-year T-note. Analysis. Don't have it. Oh, well, maybe Asher's just rude. Rates and charts. Maybe we'll try that. Oh, that's under crypto. All right, so maybe it's not here. So we'll use a different site then. I was just going to use FXStreet. That's all. So there's FXStreet. Well, I don't want to. I want to see it. I don't want to know it. Oh yeah, how was the Canadian jobs report? I thought we had Canadian jobs today. I don't see it here. And I don't see real-time rates. Let's try this one more time. All right, so it's interesting that FXStreet doesn't cover this because one of the things I teach people is that we're actually bond traders. And so while all of this is important, more important than the S&P 500 going up or down is like the 10-year T-note going up or down. So anyways, let's go to, we'll just go to a neutral site. Okay. And the point that I'm trying to make here is interest rates are already going up. Yep. Okay. So then no harm in showing this, I hope, moderator. I try to be respectful. But I wanted to share this. This is what we do here. Okay? So this is interesting. This is your risk-free rate of return. And in 6 months, it's gone up quite a bit. How about in 3 years? 3 years ago, we were at 1.5. We're almost at 2.0 now. So 100% increases from July, August, let's say August 2020. Interest rates, 100% is to 1%. 200% is 1.5. So we're nearing a 300% increase in interest rates in 18 months. Okay, now it's too low, the volume. All right, I'll beef it up a little bit. Let's go back to commodities. Okay, my oh my, WTI. Okay, oops. So one of the things I was teaching last night in the swing trading group was if you miss this, you can catch that. You could trade this or you could trade that. You could trade this, but this is where it's at. What do you think? Nice, right? You had 1, 2, 3, 4, 5. So 1, 2, you had 3 hours to get on that breakup. Trapping. Isn't that pretty? It's pretty, right? It's just price action. So I covered the same thing just in a different way. So from a bullish point of view, right? You buy on the bottom and you can buy on the breakup. I've been called worse. I'm usually told that I'm an arrogant prick. What does this big red zone mean? This means stop. And you knew that weeks ago. Anyways. Well, it's because I talk loud and I walk proud. And many people don't like that. They'd rather I change. You don't talk so loud. You don't walk so proud anymore. Read between the lines sometimes. Yeah, I've been listening to 90s Guns N' Roses. Sorry. I believe that's Estranged, if you know the song. Oh, that happened a lot long ago before I was a... Yeah, I saw that, Jimmy. Yeah, I saw that. Jim says the revision went from 250 to 650. Yeah, and that's another reason you got people have to change their models and bring down the stock market. Okay. Pretty amazing, huh? So notice this. I taught you earlier. I said there was a household survey and an establishment survey. See, and here's the established. So the funny thing is there's no non-farm payrolls report. There's actually two reports that are consolidated, and we call it the employment situation report minus farming jobs. Master says, yeah, that's a huge revision. Well, it's close enough for government work. That's 250. Oh, sorry, we were wrong. It's 650. It's pretty amazing, isn't it? I wonder why people are not fired. Or why don't they update their model? Or why do we report the most current month if there's not enough time to get an accurate number? Why don't we just skip it all together and go straight to the one where you have a full month to do the research? Let's just do the revised number only. Then you don't have to revise. But whatever. Okay. So usually it's pretty close. 142, 143, 143, 143, 144, 144, 144. Okay. Sometimes they're off 500,000 or 600,000 jobs. They can overstate by 500,000. They can understate by 500,000 with a swing of 1 million. Anywho. Man, I look at this dollar strength and I'm just so happy. I'm going to have a good Friday, man. Let's take a look at exotics and then I'll do Bitcoin. You know what? I'm going to do Bitcoin now. Let me go back. I forgot to do biddy. Biddy, biddy, biddy. Can't you see? Okay. So, what's going on here? Okay. I've had this marked up for a very long time. And as long as we're below that, I'm a bear. Cool. Now you can drill in, and then what? Well, let's say this is support. I already have it drawn, so I don't remember why. It doesn't matter. So it became here, right? Trap it here, and you buy it. Let me do the circle. Now I'll do the square. No, I'll do the triangle. You buy it here. Now I'll zoom in. Okay. Well, NFP collapsed it. Maybe. Okay. And it has to breach above this now to maintain. Well, actually, I'm going to draw it this way because I'm connecting these. So now you have to kind of zip in here. Okay. So a bear is going to trade it like this. A bull that caught the breakout pullback is now hoping that we do that. He's a genie in a bottle. Come, come, come and set me free. You got to rub me in the right way, baby. Come, come, come and set me free. I'm like, wait, is that the words? I'm like, oh my God. All right, so there he is. There we at. Do some exotics. Grab the wrong one. Okay, let's go on the big time frame first. This is peso, one of my favorite currency pairs. In the swing trading group a week ago, we were here. And we had it set up to sell here. And it worked. And now we might have something like this going on. But I need you to understand that we were here. Then we were here, then we were here, then we were here, then we were here, then we were here. Now we need a bigger pullback and then start again. Here, 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 and get a new lower low and then set up the new lower high, which would look more like that. So you have to go big, small, big, small. So if you understand the context of where we have been and where we're going, if you think we're going there, then you understand the importance of this holding, this dropping, this coming up, and now if this holds, to make a new lower low. So let's go explore that idea. Look at this. Okay? Do you guys remember? Y equals mx plus b. M is equal to rise over run. Okay? Now, by the way, in class, I would have to manually do these calculations to figure out not just the mean, the slope of the mean, but the standard deviation. You had to do it by hand. Yeah, amazing. Anyways, we have this confluence now of a 3A2 Fibonacci retracement and two standard deviations above the mean when M is less than 0, meaning negative slope, meaning bearish. So it's very overbought in a falling market. Now you say, well, that might change. Well, that might change. I'm just talking about statistics. Statistically, that's a very high price relative to what's been happening before. See, when we got to this elevation, in the past, it reverted back to the mean. When we got down here, oversold, it tended to revert back to the mean. So it's just saying, well, this is what happened in the past. Not that it'll happen in the future. It's statistics. It doesn't tell you the future. Okay? But, dude, if you were a bear, that would be interesting, right? Statistically, you couldn't get a better price. Because statistically, if it goes any higher than that, then statistically, it might have become bullish. And, of course, you would never want to sell something that's become bullish because somebody's trading this. So you got to be careful. So you really have to know what you want to do. So I'm not going to go back. Just realize this is 382 Fibonacci retracement of a bigger move to the left. And that because of the bigger move on the left, we've already sold this 50%. We, meaning the swing trading group. We set that up way in advance. Okay? And we were cheering here because how awesome this was. Cool. So now we have to measure that move. So you take your Fibonacci, you point, right? And now we're looking at this area, which says on the smaller time frame, this is the sell zone. So now what? Now you must use some analysis of price action to confirm or deny the opportunity. So what you would like to see, because this is a level of resistance, it should be support for a bull. So if bulls exist here, they're going to do this, and then statistically speaking, a lot has changed. And that this downward move in USD Mexican peso may be over. So you want to kind of trap that now. So here's our two numbers. Am I making sense so far? Okay, cool. So what these sellers are looking for, and these sellers are looking for, is a resumption of the downward move. So what they would prefer to see is something like this. And if they do, they will sell hard there. So they trapped it. Like a genie in a bottle, baby. And, right, support became resistance. And, okay, this is a lower high. This would become the new lower high. And what do lower highs predict? Lower lows. So if you sold here, you're predicting a new lower low. And you're collecting 400% a year in interest payments from the Bank de Mexico. That's pretty good from where I come from. Plus pips. How nice is that, huh? By the way, I just saw the ticker tape there, the streaming. Thank you, B-Rad, for the $100 tip yesterday. I'm going to go and buy a bottle of wine and hold it for 10 years. I'm just not sure what I want to buy. Yeah. Yeah, that's probably a good idea. It's probably a good idea that Camus is nice. Yeah, I know a couple of places I could probably pick one up. So some of my wine has been in my cellar for a while. So I bought a bottle. I was a young man, and I didn't grow up in class and culture, so I didn't know anything about wine, but I thought rich people would. And I wanted to be rich, so I'm like, well, I need to know something about wine. So I taught myself about wine, and I studied for about a year teaching myself wine. And then I decided, well, I can't be an arrogant prick unless I buy myself wine to collect. So I'm like, I want to be an arrogant prick. So anyways, so I went to Behringer in Napa Valley, and because I wanted to buy wine from them that is not sold in the stores. I wanted to buy an estate bottle. So I go there, and this is, I think it was 1994. I might say 1995. Okay, it's 1995. And I go there, and I go to the private tasting room where it's a lot of money usually to be in. That's the VIP room. And one of the vintners is pouring, and he's pouring their best wine. And then I say, I want the estate cab 1991. And he says, oh, great. Cool. I think I still have a case. And I'm like, well, here's the thing. I don't have any money. I don't have any money. I'm like, I've saved my money. And he's like, you want to buy one bottle? I'm like, yeah. He's like, look, this is our like rarest stuff. We typically don't sell it by the bottle, but usually we don't sell more than one case either. But this is really for collectors and stuff. Like, we don't just sell one bottle. And so I tell him, like, look, man, you know, I'm a college kid. I've been saving my money. I've been doing education. I'm here specifically so I can buy a bottle of wine from you, never sold in a store, and I want to save it. This is special. this is a big deal for me. I know it's $50 a bottle, but I had to save the $50. I'm not just some arrogant guy that's going to come in and some rich guy that's just going to come in and buy a case because he had a good time here and then just drink it like he doesn't care. I'm like, I care. He's like, you know what, kid? I'll sell you a bottle. I still have this bottle. 1991 Beringer Estate Cabernet Sauvignon. And it's now considered the first cult cab. And that's in my cellar right now. I got a whole bunch of bottles like that. They all have stories. It's really cool. So maybe maybe I'll buy something and pop it in there and sit on it. So I don't know how many years 1995 is, but I've had it ever since. And I think my oldest bottle is from 1974. Which now the problem is I can't drink them, right? They're worth more unopened. But anyways. So what will I get? I don't know. Okay, Mrs. That, yeah. I won't go to a store though. Most likely I'll call up the estates and do something like that. So Beringer's kind of cool. $100 isn't quite enough, but every once in a while they'll send me. I'm on a list, right? Beringer will send me a list, and they'll say, "Hey, we have like one of the things I'm collecting now are magnums, right? So they'll say we have this cab magnum, which is a 1.5 liter bottle, and it's 40% off or something. So it'd be like $200. So I might just pick up one of those. And so now I have a bigger, right? Something like that. Cool. Anyways, USD strong against peso. And Rand holding in there. So anyways. Right on, Lucas. So I think you can tell I'm kind of done. Man. I've been on my charts, 20 hours a day all week since Sunday. Kind of spent. I've talked about absolutely everything 5 times. So maybe I pull the plug here. I don't know if I'm going to buy the stock market today. Maybe I just take the rest of the day off. Not sure yet. It's hard to turn your back. But maybe we'll give the moderator the weekend 1 hour early. Yeah, I'm gonna call it. It's done. I'm done. I don't know what else to say now. If I'm talking about my wine collection, I am an arrogant prick. What's next? I'm going to talk about my watch. It's a nice watch, by the way. It's awesome. So, peace on earth. May the pips be with you. May our profits be above average. Please click the like button and show some respect to FXstreet for hosting us now for, moving pretty close to 16 years now for this one webinar. And I've been doing live events with FXstreet for, I think it's 17 years now. So a big round of applause for FXstreet and our host. Our moderator is the best moderator. No moderator has ever moderated like our moderator. There's nothing moderate about our moderator. It's an extreme moderator. Thank you. So if you liked my style and my grace, maybe join FXBootcamp.com. It's $88 a year. The second thing is, if you need a trustworthy broker with fast execution speeds, narrow spreads, huge swaps, but really an execution partner, that's what a broker does for you, executes trades. Maybe you want a service provider for your Forex business that actually sees your relationship as symbiotic and they hope through education that you succeed and that you become a patient, conservative, disciplined trader with long-term goals and values, and that you trade consistently with low risk, seeking consistent returns over long periods of time. Because if you did that at Trader's Way as a client, then you become a client for years and 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 years. And they'll provide a service and receive an income from providing that service to you, and you're happy. Everything's working great. Other brokers, what they want is you pop $500 in a new account, you make a bunch of stupid trades, you blow up the account, but the broker doesn't care because they never executed your trades anyways. They B-booked you and they figured, you know what, you're just going to make a bunch of dumb trades. So they trade against you knowing that you're going to lose your $500, and guess what? They keep your $500. Great. That's very profitable on the short run. Trader's Way instead hopes you succeed so that they can provide a service to your successful Forex trading business over years and years and years. And that's a symbiotic relationship. And they figure if I help educate you, maybe you have a better survival rate, a chance of survival, maybe even thrival. And if you like that as a business model, you're like, wow, I like that as a business model. Then visit tradersway.com, open up a demo account, and see if they earn your loyalty and respect. And if they do, open up an account. And don't worry, you don't have to tell them I sent you. I don't earn commissions as you trade. Don't worry about that. Just see if they earn your loyalty and respect, and if they do, become a client. And drop that loser broker that you're working with now. So anyways, peace on earth. May the pips be with you. May our profits be above average. Thank you for being here. Thank you, FX Street. Have a